What I would love to be able to do right now is I'd like to take out money from my house and move it into the company. And if my house was tokenized, I'd be able to do that. I'd be able to get this loan without having to, if I do this in the traditional system right now, there's so many things. I've just been going down this path. There's so many stupid things that happen and that cost me more money and that just make it not make sense. But there's so many lenders that would love to do a deal like that. The infrastructure is not there, but it will be.
People who use one asset to collateralize another asset, yes, it should be fine, but it's almost like Inception, the movie. To what dimension do we allow people to collateralize the collateralized asset? Because if one tumbles, the other one tumbles. And look at FTX, where they had all these different token pairs that were collateralized against other pairs under the same roof.
Hey everybody, welcome to Missing Links with John, Brock, and myself, Stephen King, where we discuss what's missing in Web3 architecture. For feedback, please go to missinglinks.fm, send us an email, give us some feedback on what we discuss and what you'd like us to cover next week. All right, let's get into it.
So I haven't had a salary in forever. And so I've just basically been trading to pay bills. And you can trade up crypto and you can trade down crypto. And the way that I do it is we use analogies. Brock calls it technical trading. I don't think it's technical trading. It's just you look for patterns, right? And you can look for some patterns are longer term. So like Luxo a year and a half ago was hacked, and the price got destroyed. And it was in October. Nobody was buying it. But it's Fabian from the Ethereum Foundation, right? And like his wife is like this really established. She worked in fashion, so it was like, okay, no brainer. Luxo, the technology looks good, great founders, this is going to do well. It got hit pretty hard. You're going to make a return. So that's kind of the obvious stuff. The less obvious stuff is like, and also Solana recently. So Solana went down to like $8, and it was like, okay, obviously this is not going away. It serves a very particular market, which I think is going to be like the Wall Street, and
Really
that's
soon.
from, yeah, right. So anyway, but then there's the less obvious stuff. So there's things that happen every day, and there's really crappy coins out there that you just don't have the liquidity, that aren't even worth paying attention to. But there are some that do have the volume and liquidity that go down. They get hit like 20% in one day. And you can usually make money when that happens, because if it's a decent enough team and in the market trend is either flat or up, then there's an opportunity there. And but going through these thousands of tokens you need a machine to do it. And so that's what we are doing, but we're leveraging some technology that we already built or are building under the indexing company. And so Brock put a UI onto this over the weekend, and we're looking at you have the ability to look at tokens basically through moving day averages, and there's specific data points that I just use by eyeing, but we're gonna test out. So with that said, we're looking at ETH and USD, and this looks like October of the last year, so 2022.
Yeah, so this is the last 3 months of data. We're backing up a few steps. Chainlink puts out price oracles or helps manage price oracles for 180 different currency pairs. We're indexing all of them. So every time there's a price update on chain, we grab it, we store it, we track it. And then we, over the weekend, we added this concept of moving averages for all of those pairs. So in real time, as soon as there's a price update, we track the spot price and then the 1, 15, and 30-day moving averages. And so with this like kind of crude UI, you can say, okay, give me how far back, like a timestamp for how far back you want the data, and then the quote currency and the base currency and the quote currency they want to look at. So this is the ETH USD pair going back to October 22.
And so, we realize that like TradingView and some other apps probably do stuff like this. And that really is our objective. We're not setting out to build a new trading view or anything like that. Like Brock literally indexed all of Chainlink's price feeds for the indexing company. And it's like this is just like an example of the infrastructure we're building underneath and putting a face on it so people that can see what we're doing. But also, this is helpful because I'm going to put about, I don't know, 10 grand and test out different strategies. And I'm sure maybe one of
putting your money where your mouth is, huh?
Definitely. Yeah, and this isn't going to be rocket science. I'm sure there's people that do trading every day, and they're like, "Oh, these guys are idiots. This stuff exists." That's great. I have I know how to do it just by eyeing things, and I'm not super good at it or anything like that. It's just a way to bring in money when you don't have a paycheck, right? But this is helpful, and the UI, Brock, that you're talking about that's not so good, I disagree with. I think the only thing that I don't like about this UI is that it shows ETH block numbers.
Yeah.
Yeah.
But for this example,
the improvement here, we also have price timestamps. In my rush, I didn't expose those. So what you're seeing on the x-axis is the block number that we received the price update at.
Which is perfect for now.
Is that the delta? Sorry, I had a question. Is that the delta? Because there is a delay here.
What do you mean?
So by the time you get a price update, there could be already so what's the resolution of this? Because let's say you're getting a price update every X seconds, depending on how long it takes for that to ingest. Your decision, depending on how granular it is in resolution, could be faulty.
Yeah, we're not looking at microsecond trades or order books or any of that. These are the way Chainlink price oracles work. There's a network of nodes out there. And so I think for Ethereum, there's something like 20 or 30 of them. Okay. And what it does is, for Ethereum specifically, once an hour, they go out and say, okay, give me each node, give me the current price that you have. And then an average of those prices is put on chain. And that happens once an hour.
Okay, cool.
Yeah. There's I think ApeCoin, it's every 6 hours. So there can be longer durations in between.
So if you're trading with this, you would find yourself in a situation where I hate the terminology of a flash crash when you're talking about high frequency trading, but
this isn't for day trading.
Yeah, I was going to say you could find yourself in a situation where you can have 3 bottom outs, but it even though you had those bottom outs, the average could be higher than the previous reported one, which could, if you're building a model off this, could really hinder that model.
Yes, and so Web3 is really interesting in that way because it's you have Web 2, right? And you have Wall Street that does high frequency trading, but these trades in the background settle 3 days later. And but kind of everything looks like it's happening in real time. Web 3 is almost the opposite of that. There's this high degree of latency up front, but everything does settle right then and there. It doesn't have to go through some third-party clearinghouse or anything like that. So you could argue that today's way in Web 2 is better, but I wouldn't be looking to day trade anyway. And I'm sure that the infrastructure will get there at some point. But I guess, just looking at this, it would be, I don't think I've ever day traded anyway, but I think over there's opportunities on the smallest time horizon would be a week. And, and go ahead.
I was going to say, so I know as a fact, I know Citadel, DRW trading, I know a lot of people there. They're working on trying to do settlements faster because, like you said, that's the Achilles heel. And so if they can be the market maker, the trader, and the clearinghouse all under one roof, that would really change their margin spread. And potentially, if they had a tighter spread, they could pass that on.
Yeah, that's a whole other world. We're just looking at, okay, market is doing what the market's doing. Can we write it up or down and make money on it?
Yeah, right.
But it's a good point. And so, but actually to that point, so you have DTCC, which is the biggest clearinghouse right now for most equities on Wall Street, and they're playing around with blockchain technology. And so, if Citadel is trying to be all three, I mean, maybe they can pull it off. I don't know, but it
They have
just
the
seems
money.
like
They have the money.
yeah, they do have the money, but I don't know enough about the industry. Like I don't know if there's like regulatory hurdles that they'd have to like. I'm sure you can do that. You can be the clearinghouse. Um, and then what happens after it goes through DTCC? Like, does it go to the Federal Reserve? I have no idea. There's this whole. I'm sure many people know that world. I don't know enough about it. But blockchain solves that, right? Like we don't need DTCC um, if we have if it's on chain, right? Like why would we need, you know, I don't know, maybe the government will mandate that there still needs to be like, I don't know, a pipe that it needs to go through, but that would be an unnecessary third party. So it'll be interesting to see what happens with that. Anyway, it's good questions, John. It's good questions, and so let's look at this for a sec, right? So we're looking at ETH over the last 3 months, USD. So it's pretty simple, right? I think anybody looking at this would see, okay, you've got a 30-day moving average, you've got a 15-day moving average, and then you've got the spot, and then you see the 15 and the 30-day converge. Like the first time would be, I mean, who knows what the date is, but you know, we're 15.4, so
Yeah.
that's in blocks. So let's say, yeah, right in there. So you would be like, okay, so when they cross right there, you would want to, you know, it's a reversal. We're going from a bull market to a bear market, and then they almost cross again at the 15.6, and it's just like it's continuing this trend, right? So okay, great, we're starting to see a pattern here, and then we go down and we see them cross again, but then we see a reversal in that pattern. So it's telling us in shorter, it would, I mean, if we had dates, it would be a little easier, because if we saw these first two, you know, we might make the wrong bet actually. Because if we look at the 15-day moving average and we follow it when they actually cross the first time, we see the price go down over a longer time period, right? So it does spike, and that's where a lot of people get caught. So that's why you have to have you have to have enough data. So what you'd have to do really is look at this over a full year, and you'd have to compare it a full year to 6 months, and then you'd have to do it, I think, even on 3 months. And it just depends on how long you're gonna hold. And then, because you might get caught up in this one spike and say, "Uh-oh, our thesis is wrong," and then if you buy into that, you're screwed, because then it drops back down.
Well, so
that's John. That's what we were trying to do. We're trying to find theories, and so I'm like looking, and I can point out like these easy ones, but I also use Chat GPT, and I said, all right, let's see how smart AI is on this. And so I was using Merlin. It's like a browser plugin, and you just do like Control M, and it brings up this Merlin bot, and you just say, hey Merlin, you know, you're a smart technical trader. You're really good at what you do, and let's test that out. Brock, do you have Merlin?
I do not.
Let me see.
One thing that would be interesting here, and this, you know, we could edit this out of the video thinking about it, is that on top of the index data, adding agnostic tools on top of it, where you could test different types of pressure points in the data. So if you have a graph and you have a theory about the data, you could just plug in those parameters. It doesn't use any AI, and it linearly goes through that data and kind of tests the theory. Because how I see this here is in high frequency trading and a lot of trading firms, they have so much data. Like, it is stupid how much data they have. And what they do is, when they design a model, or a quant designs a model, they will do like 2-year back testing, where they'll take that model at day 0 and simulate the last 3 years of trading activity and pips, or whatever kind of order flow they're looking at, and see how that actually, you know, affects the model. This would be a really interesting application, especially thinking about the resolution of this data, and thinking, is there a more common pattern, or is there a more abstract pattern in these price movements, or is there a more uh, a finite pattern where it's based on certain factors that can be defined by time, weather, stuff?
Yeah, you can get super complex. So there's something called whalewisdom.com, and I do this in I'm not nearly as successful because there's less volatility, but in equities I've been doing this. And you can build these exactly what you're saying, not to the extent that you're saying, like you can't build like quant models. But you can build and mimic and do things like that. But I don't think you need to do stuff like that in crypto right now. Like crypto right now, there's really two things that you can be successful. I mean, there's many things I'm sure, but arbitrage, which is it got to be saturated, right? Like I buy on one exchange.
Oversaturated.
Yeah, exactly. But this is yeah, here we go.
Wait, Steven, are you becoming the next SPF at this point with
No.
arbitrage?
No,
Everyone
no,
wants to
I'm
do
not.
arbitrage.
I know nothing about this stuff other than the only thing that I can do, and everybody can, is look for patterns and things. And in crypto, there's so much volatility that those patterns are very obvious. And it's a lot of risk, right? Like I've lost a lot of money too. But if you can be a little bit more right than wrong, then you can at least pay the bills.
Right.
But the challenge, John, though, is, and Brock and I were talking about this, is there's not, like, shorting is not easy. And I used to be able to do it on synthetics, but I don't know if they like, there's another exchange that's somehow associated with synthetics, but you could buy these synthetic derivatives. Now on Kraken, or not Kraken, on KuCoin, you can buy these tokens that are actual derivative tokens. And so that's kind of interesting, right? Like you're buying the token and it either goes up or down. And it's the derivative is based on, are you shorting? Or are you going long? So if I buy a derivative on a shorting Bitcoin, I'm buying this token that as Bitcoin goes down, if it falls in price, this token goes up. And then, you're assuming there's enough liquidity there. And there is for Bitcoin. You can do like tens of thousands of dollars in
This is
trades.
almost like an
But if you
options
did,
contract at the end of the day. It's just a
yeah,
more
yeah.
fluid options contract.
Right. Yeah, precisely. But you're also relying on the look. I mean, that's the nice thing, right? The options contract. Well, there's liquidity there, but these tokens on KuCoin, if you had like a TD Ameritrade actually create a feature like this, and Wall Street actually got into these derivatives, if we had even a hundredth of the liquidity that there is in traditional finance, then these derivative tokens would have a hell of a lot more liquidity than the options contracts right now do. Because you can sell a piece of that contract. You don't have to sell, like right now on an options contract, you're getting 100 contracts when you that's like the default. That's like the minimum that you get. So, or the one contract is 100 shares. Sorry.
But I feel like if you're going to be splitting up a contract, this personally mimics almost, the 2008 crash where they took a single mortgage backed security and they broke it up multiple times. Like, and depending on how it was stacked, parts of that stack would go up or down depending on what the market was. Like, are you
yeah, but John, so that's a great example though, because and that's really good that you point that out, because that actually, if people had insight into that, there was a very few people could see, that were looking around. It's like in crypto, right? When things get overheated, we've been through enough cycles where we're like, all right, you know what, probably should, cut our stacks a little bit. And those that were like in real estate or just had been through a cycle before could see that, like, hey, my nanny's buying condos and flipping them, and like something's not right here. Like you shouldn't make these kind of returns.
Well,
And
the Big Short, they literally in the movie The Big Short, they go down to Miami and they're like at a strip club, and the stripper has like 6 properties and like 4 mortgages, and it's like,
yeah. And did you like look at what they had to go through? I think we lost John, but look at what they had to go through to create those collateralized debt obligations, right? They had to like create these instruments, and they were like, it was literally like just passing paper, like physical paper around. But if you had crypto in '08, like those that had an eye, first of all, a lot more people would have insight into the craziness that was going on. Maybe not actually, because well, actually, yes, they would, because FTX, that was behind closed doors, and so was Bernie Madoff, that was behind closed doors. But if everything's on chain, right? Like if '08 happened again today and it was on chain, then I would imagine that a lot of people are going to see that market opportunity. Now, some will see it sooner than others, and they'll make that bet. But that's where I think that those options derivatives that you're talking about, those CDOs or whatever they are, like if you can not only access them as a common person, but they can be tokenized into smaller fragments. I think that adds a lot of liquidity to the system, and I think it de-risks a lot of things. I think where things go wrong is when nobody can see what's going on. Well, I'll tell you what. I'll tell you how it would work. And there's unanswered questions around KYC, right? But if you use I can like take. I've done this. I've like taken a chunk of my ETH that I didn't want to pay tax on, and I didn't want to sell it, and I borrowed against it. I had to over collateralize the contract, and I borrowed against it, and then I got real dollars. I had to jump through some hoops to do it, but I think I got I went from DAI to USDC to Coinbase into my account, and I was able to pay bills for a couple of months, and luckily I did it when the market trend was going up, right? But if it reversed, and there was I could have gotten wiped out with my ETH or a portion of it. So, but people don't want to over collateralize, but let's not go there yet right now. If I could do this right now with my house, Brock and I are building a company. What I would love to be able to do right now is I'd like to take out money from my house and move it into the company. And if my house was tokenized, I'd be able to do that. I'd be able to get this loan without having to, if I do this in the traditional system right now, there's so many things. I've just been going down this path. There's so many stupid things that happen and that cost me more money and that just make it not make sense. But there's so many lenders that would love to do a deal like that. And it just, the infrastructure is not there, but it will be. But the over collateralization is not ideal. But if you could collateralize one asset with another asset, then I don't know, there could be something there. Like and people do this. They borrow. Rich people borrow against their stocks, and they've been doing right. Yeah, and it's like they got free money for like 10 years. I mean, it was risky, some could say, but those that did it, I'm sure did very well. So, there's again, there's going to be like a lot of things that happen between here and that endpoint, and a lot of things that go wrong. But I think it's a better system in some ways. In other ways, it's maybe not so much.
I was going to say, like, rich people do that already. Look at Elon Musk taking Twitter to the ground with his Twitter stocks. And that's the thing. Like, people who use one asset to collateralize another asset, yes, it should be fine, but it's almost like Inception, the movie. To what dimension do we allow people to collateralize the collateralized asset? Because if one tumbles, the other one tumbles. And look at FTX, where they had all these different token pairs that were collateralized against other pairs under the same roof, pretty much. And that's the thing. Like with Elon Musk, taking out a loan, the bank uses his stock options, his stock ownership as collateral. I could see more violent swings in the market if this becomes a norm, if that makes sense, because it's almost trading on margin. A very small swing can knock you out of the market.
See, I see the opposite, and I actually because you're how do I put it? You're magnifying that risk. Yeah, but
by collateralizing something.
But you can see it. I mean, right now I can't see anything. Like nobody could see the relationship between FTX and Alameda. But if you could see that on-chain relationship between the two entities, I mean, it was a symptom of the existing system that doesn't work, where things are done in behind closed doors or in dark
Fair
pools.
enough.
And
Yeah,
John,
fair enough.
no, but not to no, but I don't want to jump the gun, because there are dark pools in Web3 too, and
Right.
and Starkware and all this other stuff is going to magnify that. So it's not a one stop solution. You're making very good points.
Not a
That
one-stop shop for the end of the world kind of thing.
Yeah, and so it's like we're making trade-offs, right? And but the thing is that the reason I don't like equities and is because markets are I don't believe markets are efficient. I don't believe that hypothesis, but I believe that people are pretty good at exploiting gaps or opportunities in the market, and it's a very competitive landscape. Crypto has not been that competitive. It's getting more competitive, and volatility. Most people hate volatility, but that's where you can actually go from having no money to actually climbing the economic ladder, because you have to take a lot of risk, and you have to be able to go broke a few times. But if you can get used to that, then if you keep pushing, I think a lot of people can figure that out. Whereas, like, if you're going to earn 1 or 5% in the market, yeah, compounding's great, but you'll be 70 by the time that you can recognize any of that stuff. And maybe that's nice, but like my kids, they can make their own money. I want to enjoy life now and travel and do all that jazz. So,
So the one thing that I found very fascinating, and I was reading about this, it's kind of little, I don't want to say it's morbid, but it's very interesting to think about. It's a group of people that spent their whole life doing what they were told, doing, saving, investing in all this. And it took one medical emergency, one change of life circumstance, and one kind of um, bad incident that destroyed their life financially. And they had no closure. They had no visibility in where their money went their whole life. And it's a very thing. Like, we trust the institutions because that's the contract of society. But at the end of the day, we're kind of responsible for our own fate, and that includes our well-being financially and where our control lies as a collective whole. And I think that's where it's very important to get. I think that's where the traditional Web 2 system versus the Web 3 system. The Web 2 system sees it as a threat and is willing to adopt it. But if they have too much control, they can squash it. And that's my concern, because we can see all these cool technologies. And like anything that's new, there's going to be people that exploit it. There's going to be pitfalls. Look at the run on the bank in the Great Depression, right? When we left the gold standard. All of these are components of an evolving system. I think these are the pains that we're suffering now.
Yeah. We're definitely, yeah, it's going to be interesting to see how things play out. I'm excited about AI, but not as excited as I was for crypto. You can't buy token. If I want to go invest in an AI company, I've got to have like a pipeline, of like connections and things like that. And it's just to your liquidity conversation and all that. I really do think crypto is still a unique opportunity for a lot of people. I think that it's going to, I don't know, it's going to make things better and worse, as we sort of transition or combine these two technologies. But for now, we'll see. We're going to put 5 or 10 grand into this very, very simple trading strategy, and either lose it.
How about you back test it? Not a financial advice. How about you back test it, since you built the technology, first of all?
Yeah, I hate doing stuff like that, John. I'm like, let's just put it in there. But Brock is good.
I know you do. I've known you for how many years? Close to 6 years. Well. I've known you. Yeah.
Yeah. Well, no, but you're the sensible one among us, and the back
really.
Yeah. So he named the company the indexing company, and so many people are like, "That's the most brilliant name." Because Imbrex, nobody knew what Imbrex was. They're like, "What the hell does that mean?" And then you go through this spiel, and people are like, "What? Ancient Greece? Like, what are you talking about?" And like the indexing company, you don't have to waste any of that energy. People are like, "Oh yeah, you're like an indexing company. Okay, cool, makes sense."
Well, it's great. We've had a few people like asked what our name is after we tell them. We're like, no, it's literally the indexing company.
The indexing company.
And John, you know what he wants to call?
Did you put the copyright in that yet?
I applied for the trademark.
There you go.
Yeah. Well, I learned that lesson the hard way. We got sued at Rex, and you know, a lot of money later.
The moral of the story here is always backtest your code and don't get sued.
Definitely get everything trademarked. Cool. This has been a good episode. This is very different from any other episode that we've done. So, we still can't get these two people to give us any kind of feedback, but we appreciate you downloading it, even if it's automated. And if we do get a third person and you do want to leave feedback, please do so on any of the apps. We'll see you next week.